Welcome, everybody. We'll get started in just a moment. I got just a few more clicks to do before we are ready. Okay. Oh, I do need to stop that sound. One second. Nice to see you, David.
Nice to see you, Karen, and everyone else.
David is interning with me this spring and doing yeoman's work. Okay, everyone. I think we are all set. Thank you. We are all set. Okay. Thank you for being here today, everyone, for asking me anything about HoldCo strategy with Chenmark. We have our guests today, Trish Higgins and Edward Cody, and I will let them speak in a moment. I'm going to do an announcement, and then our upcoming sessions and a few sessions that I've gotten wind of as well that you may want to know about. And then we will get started with the meat and the heart of the discussion. So the first thing is the announcement. I launched the Nuts and Bolts program last year. It is a cohort-based program. We're in our second cohort. In fact, I see a few cohort members in the audience as well. So I know that they've been busy studying, so I'm glad they've been had a time to come out today for it. I got a lot of questions about hosting another cohort this year, which would be an impossibility for me. So I am now fast and furiously working on a self-study version so that folks who cannot wait until next year for the cohort version will be able to do the self-study version. That will happen, release in April. So I look forward to that, and I look forward to being able to bring more information to more students. The focus of the program is on the launch of your search, really reflecting about what you want, and then also some of the practicalities of doing it. It is search model agnostic. I just want you to choose the one that fits your basically your view of your life in the future. So let's go to the pipeline prep events that are coming up. There were a few posts on Search Funder that I saw on management operating systems. And so I feel like it was coincidence, but excellent timing that we have Dave Newberry coming in. He has implemented a couple of different operating systems, and so I think he has a unique perspective to provide on that. And then we have an attorney from Goodwin Proctor. Goodwin is as far back as I can remember, has done the legal counseling for traditional searchers. I don't know if they were there from the beginning, but I think for a very long time, very experienced on the traditional search route. So Jeffrey Coe is going to come in and talk about legal considerations in a search acquisition. Then we have an expert coming in on platforms, an expert that was found by my intern that I gave a shout out to earlier. So I'm really looking forward to speaking with this expert on strategies for success in that. So next slide is, I'm not going to read everything on there, but I do want to let you know about the book club. We're going to have Jan Simon in to talk about his excellent book that's gotten great reviews from searchers. And Jan is a professor at IESA and also a prolific investor in searchers. So I think it's going to be a great discussion. The book is kind of thick, so if you're planning on doing the book club and haven't read the book yet, be sure to pick it up soon. Now, here are a few events that are happening in the Search Fund ETA community. The first is the Wharton ETA Summit. That is an in-person summit at Wharton later this month. And then towards the end of the month, there is a meetup in Florida. I think that this meetup is going to get the award if we were giving awards out for best location or most fun location to have one, because they're doing it at an acquired company and it is at an air show. So I think that one's going to win. I mean, we are in the first quarter, but still, I think it's going to win. And then there's the MIT X NETA conference. NETA is a coalition of the Northeastern schools ETA clubs and ETA programs, and they're joining up with MIT for their conference in mid-April. I will be there. And in fact, the day before the conference on April 15th, there will be a Women in Search, Women in Business get together. So stay tuned for that. We're getting that all organized, and I will be a host for that. As well. So lots of great things are happening this spring, as you can see. So let's get to the meat of things with the Ask Me Anything About HoldCo strategy. I want to welcome back Trish. She did a session a while back and talked about her journey and what to think about as an investor. And it's so exciting to have her here. And then there's Edward Cody, who just this year became the CEO of his company and I think still is, a generalist vice president with Chenmark. So Trish, I'm going to turn it over to you to introduce yourself and to tell us about Chenmark. I've got a lot of questions about accelerators in general and what the differences are between them. So I'd love to hear from you on that.
Awesome. Well, thanks so much for having us. It's great to be here. Chenmark is, I think, a little bit different in the search space. We started in 2015, founded by myself, my husband, James, and my brother-in-law, Palmer. So we are a weird founding group. So we are truly a family business. And even though I went to business school, I did not take any search classes or anything. And it was a little bit after business school where James Palmer and myself were all having a little bit of a, looking out and saying, we were in more traditional finance jobs and we felt like we wanted to do something a little bit different. And the idea of buying small businesses from retiring owners came up as, a potential option. And it really just started with us Googling, how do you do this? And one thing led to another, and reaching out through BizBuySell to business owners and that sort of stuff, because the space has really evolved so much in the past, 5+ years, that in 2014, 2015, there were very few resources like Search Funder and, webinars and all this sort of stuff. And so I was talking to a friend of mine about what we were doing, and she said, I think that is sort of a search fund. I was like, oh, okay, good to know there's a name for it, and kind of looped in with some of the community at that point in time. I think because we kind of came at it from our own angle, we're very much looking for the same types of businesses that traditional search funds buy. Steady businesses, have been around for a long time, retiring owners, really consistent cash flows. But we had always wanted to buy more than one business. And so sort of from the get, we'd said, we think that we want to buy one business and then use the cash flows from that business to buy another one, another one, another one. And we want to have a really long-term orientation with our businesses and not be looking to sort of buy and sell in a couple of years and that sort of thing. And so that was our idea when we sat around a kitchen table in 2014. And it's still very much our idea. Nothing has really changed there. So fast forward to today, we are a C Corp holding company structure. We have 10 different businesses under our umbrella. We've done many more acquisitions because some of our companies have grown via acquisition. And so we have 10 different CEOs that are all we have 8 businesses in the US and 2 in Western Canada. And our headquarters is up in Portland, Maine, even though I strongly dislike the word headquarters because it feels a little more grandiose than it is. We're basically continuing to use cash flows from the businesses, buy more businesses, and kind of grow from there. And a couple of years ago, we realized that we had cash flows coming from the business and we had deal opportunities, but we unfortunately had nobody to run the businesses. And finding people to run these smaller businesses is a very sort of unique sort of skill set that you're looking for. It's a very hands-on job. It's not sort of something that you just put an ad out on, LinkedIn and hope for the best. It's I think a really unique person that wants to run these businesses. And so we started what we call the GVP program, or Generous Vice President program, a couple of years ago to bring people in to work with us, train with us, and eventually sort of become the CEOs of our business. So Edward was really sort of the OG GVP. He joined us before there was even a program. And so I'll let him share a little bit more about his journey with us for the past couple of years.
Cool, thanks, Trish. So I actually started my career working in venture capital, where, as you can all imagine, really the focus of everything you do there is growth oriented, just kind of like dizzying growth. And through my time and tenure there, I found myself increasingly gravitating to areas where the focus wasn't on growth. The focus was really building a great business. And increasingly found that, if your focus is building a great business, you have to, purchase that business for a reasonable valuation, not a valuation predicated on everyone on earth using that service. So as I was working my way through venture, I was certainly colored by my parents are both small business owners. So started to increasingly become aware of this kind of section of the world of search funds and permanent equity companies like Chenmark, among others. And through that learning, I actually wrote Trish a cold email to learn more about Chenmark. And the more I learned about Chenmark, the more I felt like, this is really a place I want to be, both in terms of just the mindset and approach to the type of acquisitions they did and the long-term oriented focus, which felt really unique and special. But also felt like it was certainly a group of people I could learn from and a community I could learn from as well. So I came aboard in the early days of the GVP program, was working at one of our landscaping companies in kind of a finance operating role and kind of worked at a couple of those, and then ultimately became the CFO of Mainly Grass, a lawn care company we own, and became the CEO of that business January 1st. So I think this is technically week 10 in the seat.
That's so wonderful. I have so many questions, and I know that the audience has questions. So I'm just going to ask a couple and then want to let folks who have not participated in one of these before know that you can put a question in the chat and I will read it out for it to be answered. Or you can raise your hand and then unmute and when I call on you as well. So want to make sure that folks get their questions answered. But first, before I get going, I am going to officially put them on the hot seat so that they are spotlighted for everyone. Uh, so can you tell me a little bit about the process today? Let's just start with a searcher who's listening today might want to enter the program, what it looks like now, because it sounds like it has evolved.
Sure, I can take that. So once somebody is hired into the GVP program, there's 3 stages. The first stage is working with us up here in Portland, Maine, which is delightful, and working on sort of helping with deal sourcing as well as supporting company operations. So we don't really do deal sourcing the way a lot of searchers do, which is sort of voluminous amounts of outbound cold sort of things. We do a little bit of that, but we do a lot more sort of targeted outreach, particularly for industries that we're already in or geographies that we're in. And we thankfully at this point also get a fair amount of inbound, which is great. And so we have people sort of at that first stage help with that, but then also help with supporting company analysis, that sort of thing. And the goal of that stage is really for us to get to know that person and for them to get to know us and just get a sense of our culture and our values and meet different people within the organization, because we sort of fundamentally are a decentralized business. So, when Edward becomes the CEO of Mainly Grass, he is the CEO and he's making decisions, and, we have some guardrails, but he's kind of on his own, I think, in a good way. And so we are using that first time to really get to establish relationships with people, because it is about sort of trusting someone's judgment once they're in the seat, and that they also have a good enough relationship with us that they feel comfortable sharing good and bad news and working together as truly as a team. So that's stage 1. Stage 2 is going to work in one of our businesses as some sort of operating role. So that can be branch manager, CFO, COO, sales, something where you're working in one of the businesses. And that's to kind of say, okay, it's great that everything's all nice when we're sitting at desks and, in an office, and you can do analytical work, but can you then take that basis for that analytical work and go out to the real world and talk with a real team and, have some learnings there that are kind of impossible to have without actually doing it. And then once we have a new deal and a new company, it's at a certain stage in the process and it seems real, we send an email out to people who are in that second stage and say, hey, we've got this deal, it's in this location, here's all the information, who is interested? And from there, some people raise their hands, some people don't. And then we kind of figure out who's the CEO from there. So we'll only hire from that internal group to be CEOs. So we're sort of as good as our team. And the timeline for that is we've had probably the fastest someone's gone from hire date to CEO is a little over a year. And on the slower side, some people come in with different sort of skill sets and backgrounds. So they might need a bit more time in each stage. I would say that if Edward joined today, he would probably go through the ranks a lot faster than he sort of originally did, because it took us a little while to figure out, what we were doing and which way was up. So that's pretty much, it's a little bit different for each person, but that's essentially the structure of the program.
So Edward, talk to me about your experience in the operating companies and how did that translate into your experiences now as CEO 10 weeks in?
So, I think the thing that just so initially important to keep in mind when you enter these organizations is you're entering organizations where a lot of the folks who've been working for that company have been working for that company a long time and have a lot of experience in the industry that they occupy. So, you could walk in with your spreadsheet and say, hey, you're pricing this wrong. You're pricing this job wrong. You're underweighting your kind of gross margin. And the fact that you've had that insight, that kind of analytical insight, is great, but it's profoundly a different thing to then convince the team and get buy-in from the team to implement that information and use it to kind of drive the business forward. So I think the thing that I was struck by most was how much time needs to be spent up front, just demonstrating that you're there to help, that you don't know any better than them, that you're really just here to help them and help drive the business forward, and kind of leverage your skill set and experience to help drive the business forward. So, I read somewhere, it's like the first thing you try to do is like fix the broken light bulb, and just try to find ways to add value to the business in small ways to demonstrate that, you really care about the folks that work there, about the success of the business. And it's not really just about you or your kind of like, quick ascent to the organization.
So I'm going to ask one more question of you, Edward, and then we'll start turning it over to the audience. We have a couple in the chat and then one person with their hand up. So I'll take the person with their hand up next. So Edward, you were engaged before you became CEO with the company, saying, I presume raising your hand like, yeah, this is one that I'm interested in. And I'm sure you had some expectations going in on day one about what the company was going to be like and all of that. Stepping to the other side, now that you're CEO, what's the difference in the vision? Like, is the dream kind of close to the reality, or where are there market differences?
So I think the first thing is, I was the CFO at Mainly Grass, and really felt like knew a lot of the parts of how we ran and kind of what it took to run it. The second I switched over to CEO seat, you're like, wow, there's a lot of things that I didn't know. There are a lot of parts of this organization that I didn't know. And there's a lot of things about being a CEO that I wasn't aware of. A small example of that is how much of your role is kind of, you're in the approval business, where someone is, hey, can you take a peek at this? Hey, can you look at this? And ultimately, kind of, in some ways, you're the last line of defense. Obviously got a lot on the line yourself as a representative of the business. So, you care a lot about making sure each part of the business is the best version it can be. So I was certainly surprised by that transition, where I felt like I had so much proximity to the role itself. I knew what it was, but being on the other side of it, it is surprising how different it is. I would say 10 weeks in, it's been awesome and it's been a lot of fun. It's been incredible learning, but I think a vital piece of that for me is that there's 9 other CEOs in the Chenmark portfolio who are a phone call away, who are reaching out to check in, who are filled with just like infinite wisdom of like what that first week feels like, looks like, that first month. It's everyone kind of has deja vu having those conversations because they've so lived them themselves and are instrumental supporters in helping new CEOs like myself kind of navigate that process and come out the other side most productively. So that's been awesome, and kind of a reminder of like why I was so excited to join Chenmark in the first place.
That's wonderful. That's wonderful to hear. So Tyler, go ahead, and then anybody else who wants to raise their hand, feel free.
Cool. So Trish, forgive me for the super tactical question here. I actually just went under LOI on my first tuck-in after acquiring my first business a year ago. So a couple things are really top of mind for me right now. Number one, so do you treat a tuck-in, say like as a wholly owned subsidiary of your platform, or just have the platform acquire the assets of the tuck-in directly? And the example I would use is probably for your landscaping companies. When you acquire a tuck-in, does it go a wholly owned subsidiary or directly to the platform?
I would say both.
Okay.
In some scenarios, we do just a separate LLC and sort of it's a subsidiary. But in most landscaping transactions, it ends up just being we're acquiring the assets and we're just rolling them into into the platform. So usually on a service-based business, we just put them, we smush them together.
Okay. And quick follow to that. At the HoldCo level, I just learned about the accumulated earnings tax, which I'm sure you're very familiar with. I can't imagine you're able to utilize all your free cash flow on a given year at the HoldCo level. But so are you paying that accumulated earnings tax, or are you able to avoid that through some other mechanism?
I remember doing all the research on this. We are able to avoid that. Exactly why, I don't remember exactly right now, but that is not something that we have to deal with.
Okay, good deal. Thank you for both of those. Appreciate it.
Yeah.
So I have a fair number of questions in the chat. I'm going to read them in order, so we're going to be jumping around a little bit. So how does Chenmark structure long-term incentive plans for its executive managers, given that they are, and this is a quote, permanent capital vehicle and stock options are likely not available?
Sure. So we're actually in the middle of doing this all right now. So this is an important question. We had a couple of iterations that were quite bad when we first started. About 3 or 4 years ago, what we decided to do was switch to every sort of CEO, as well as people in the GVP program, kind of other management, are compensated based on the free cash that their company produces. That is paid out in cash, usually annually, sometimes more frequently, depending on the business. Once a year, we have a framework for evaluation of Chenmark Holdings, sort of as a consolidated entity. People have the ability to invest the amount of their free cash flow bonus into shares in Chenmark once a year. So if you got $100 bonus, you could invest up to $100 in, that year in shares. So we send out an email to everybody who's eligible and say, hey, here's the earnings of, the earnings, here's the valuation, here's all the information. This is the share price for this year. And people then have a period of about 2 weeks to submit buy or sell orders. So they can buy or sell at that price at that time. And then we kind of, settle the book internally, and then kind of go from there. So essentially the magnitude of compensation is based on each individual person's company's performance, but the currency is Chenmark stock. And if we ever have more sell orders than buy orders, the company can buy them back. If we think it's a good deal, which obviously we probably do. Or we have the ability to turn it into a note that we pay out over 3 years, just to protect ourselves. We've never had to do that, but we intend to be in business for a long time, and so it'll probably happen at some point.
I have a hand raised. John, go ahead.
Thank you, Trish and Edward. Just wanted to ask a question as I'm on the beginning of my journey as a self-funded searcher and plan to structure a holding company. Just want to understand maybe the logic and thought processes in terms of the way that you set things up in terms of the entity structures. So I know you had mentioned that you guys are a C Corp, and then there's sort of entities that fall under that. How did you guys think about that is kind of my first question. And then second question is, how do you generally handle distributions or just making sure the investors get their money back, given that a lot of models are based on, a 5-year or 7-year exit? Would love your insights on that.
I'll take the second question first. I can see Edward smiling. The investors are largely myself, James, Palmer, and our employees, and none of us expect to get distributions for a very long time. So if you want to sell your shares, you can get some money, but no distributions here. It's all staying in the company to buy more businesses. So sorry, Edward, if that's news to you. I would say when we first started, we actually didn't really spend a lot of time on structuring when we first started. The first deal we had was an LLC, because that's just like kind of what you do. The second deal that we did was in Canada, so it was its own thing. The third deal, same thing. And by the time we had 3 companies, we started to realize that if they don't all sort of have a common C Corp umbrella, or it could be an LLC umbrella, but if they don't have a common umbrella, it's very difficult to transfer cash in between businesses without having any sort of tax friction. So at that point, it was about 3 or 4 years after we started, we did a bunch of research and ended up converting to a C Corp. At that time, one of the main reasons that we did a C Corp structure, even though it can be tax inefficient for distributions because you pay taxes at the corporate level as well as the individual level, is the section 1202 of the tax code, which is, I am not a tax expert by any stretch of the imagination, but if you're buying certain types of businesses and you're under a certain threshold when those shares are being issued, you're essentially exempt from capital gains if and when you sell, as long as you own for 5 years, which we clearly intend to do. So for that reason, it seemed like a no-brainer to do the C Corp structure. And it also just allows us to very freely transfer cash between all the entities or move it up to headquarters for a new acquisition. And so that was the rationale behind it.
Great, thank you.
So I have a question in the chat about central services. What are they that are provided at the HoldCo level? They want to know about your tech stack to manage your portfolio, and also if you've formalized a post-acquisition playbook for growth. So, and I can repeat those, but let's start with the central services question. What's your central services model, if you have one?
Edward, you want to take that?
Yeah, so there's a couple different pieces to it. The first one is on the technical side. So we have a Chen Tech team consisting of 3 individuals now who is insanely helpful on 2 different levels. One is kind of just like the block and tackle reality of owning a business. That could be literally Wi-Fi. For us, it's tablets in terms of employees punching in, punching out, which might seem small and trivial, but that stuff really looms large and can really hold an organization back. And then the second piece of it is figuring out like the high level fixes. So for us, we use I would describe as somewhat of an ancient ERP system that we wanted to build an API integration with HubSpot, a profoundly difficult thing. And that's something that the central services Chen Tech team takes on. So I would say I'm a cheerleader in that process. And Dave, who leads that team, is really driving it. And I'm just there to, answer questions. Contrast that kind of on a different side, we have marketing and recruiting, where, Sarah and Trish, correct me if I'm wrong, kind of spirit guides in that process. Hey, here's what you should be thinking about on the marketing side. Here's what you should be thinking about on the recruiting side. Here's some kind of best of breed tools. But ultimately, where the operating companies themselves or the individual executors of it, they're just kind of helping us make the most informed decisions along the way. I say that, but our central service marketing professional is deep in the weeds building a new website with me right now. So it varies situation to situation.
Yeah, our kind of goal philosophically has been that any Chenmark company could be cut off and operate just fine. So, we're not doing any core functions other than some of the helping with the tech stuff. We're not doing any core functions centrally, but we have resources available if people want to use them. So I would say Edward has does a good job of using the resources that are available. There are some companies that, they like their local provider and they're fine and they choose not to.
Do any of your companies, would they be in a position to provide services to another company in the portfolio?
Would they, Edward?
Services to outside the portfolio?
Well, I'm thinking of like if, you had one company that was in the same I guess, supply chain or stream as
It's
another
excellent
company?
sentiment.
Would they be one be a customer of the other?
No.
No.
We get a lot of inbound, particularly on the lawn care side, because Mainly Grass has built out some incredible tools with the central services team, but definitely.
And then the other question was about a post-acquisition playbook for growth. Do you have it to a cookie cutter point where you can hand somebody a book and say, go grow your business?
No, I wish it was that easy. I think one of our core philosophies is that you earn the right to take risk. And so we are generally much more focused on somebody becomes, a CEO of a new business, or sorry, better said, new CEO of an old business. You need to take your time to understand what, that to make sure you have a really solid base from which to grow off of. And for some people, that doesn't take that long. But for other people, you need to implement an ERP system. So, if you try to grow without having good systems in place, bad things can happen quickly. And so we really are focused more on, okay, how do you make sure you've got really solid HR processes, good sales processes, you've got a system to help you make sure you understand where you're losing money or where you're making money, what clients are profitable, all this sort of stuff. Make sure you've got a good pricing strategy down, all that sort of stuff. And once you've got that down, then, from there you can grow. In terms of a playbook, the reality is it's different for every company. So some of our companies are in industries where it could make sense to grow via acquisition. And, you can spend more time on doing that. There are other companies that, it makes a lot more sense to grow organically. And that can look different for every different type of business. You can also have a business like Mainly Grass, where when we first bought it, it made sense to grow via acquisition. And then the multiples in that space became so crazy that now it makes more sense to grow organically. So, I think we really focus on making sure we've got a good base to start from. But then in our experience, growth your growth strategy is very dependent on what industry you're in, what geography, sort of all of that sort of stuff.
So next question is, have you ever acquired a company that a searcher brought to you? And if so, what role did that searcher play in the operating company within Chenmark?
So we have not. We have had searchers bring us deals, but unfortunately, when searchers bring us deals, they often bring them to us with like a 30, I need to close in like 2 weeks or something like that. And they're just looking for money, and that's not really our thing. So I have talked with searchers and said, if you involve us early in the process, it's more likely to happen. But we buy 100% of the businesses. And so maybe we could have some variation from there, but we don't really fit well with people who have a ton of other search investors or anything like that, because we have a very specific way of working, as well as in the holding company structure. We do need the ability to move cash around, frequently. And so I think if somebody is interested in having Chenmark back a deal, talking to us early in the process, understanding what the parameters that would work for us or not, is kind of the best way to make it happen. So we certainly talked with people, but nothing's happened.
So the next question is about the differences. I do get a lot of questions about what's the difference between traditional and the accelerator model. And I think you have a unique model with even the kind of broad term of accelerator now. So the question is, what are the key differences between Chenmark's GVP to CEO track versus a traditional model, searcher model, from the individual's perspective? So Edward, what would you say would be the differences? And then I'd like to hear Trish as well.
I would say there's probably quite a few. I certainly had a lot of folks encourage me to do this initially when I was kind of starting the whole process, and when I had originally reached out to Trish. I think the things that loom large for a variety of reasons. One is, the timeline to find a great deal is very unpredictable. And then relatedly, really knowing if something is a great deal is inherently unpredictable as well, right? You can do diligence, starting my career in venture, like you can do diligence something till the ends of the earth. There's still a ton of inherent unpredictability of, is the team happy? Are the customers actually happy? Are the customer's relationship with the business or the customer's relationship with the singular founder who takes them out for dinner every Tuesday? So there's just a huge swath of unpredictability there. So I didn't find that particularly attractive. And relatedly, I certainly felt like I had a lot to learn as well. These are certainly very unique businesses. So for me, it was, being in a place with folks who have experience in these deals, know what to look for, know what to evaluate, and then also being on a team with those folks and learning from them on how to best operate these businesses. So those were kind of the big criteria for me. But obviously kind of varies person to person.
Yeah, sorry, I'm just getting over a cold, so I'm coughing sporadically. I think Edward said it well. I mean, for a searcher, for some people, they hear about the search model and it speaks to them, and that's the right fit for them and their personality and what they want to do. And, they should 100% do that. I think in an accelerator model, I'm not an expert on sort of the more traditional accelerators, but, you're still searching, but you're searching with a group around you as well as sort of somewhat secure funding, assuming you find a deal that your backer likes and wants. And I think that can also, work well and, give people a fair amount of flexibility for what they're searching for. For us, we tend to resonate with people who are sort of interested in search, but are almost at like the periphery of search. Often people who are just kind of hearing about it, but, maybe they're, a little nervous about just the deal process or going it alone for 1 to 2 years or whatever. So for us, I think the GVP program is, 1, you're getting paid a salary, so you're not doing a self-funded search. 2, you're not making personal guarantees on debt or whatever. I have the pleasure of doing that for you. 3, you're learning some search skills, but also hopefully, actual operational skills along the way, so that when you step into the CEO seat, you've actually been in some of these roles and can hopefully take some of those learnings with you. And you're also doing it with a team. I think we have a pretty team-focused culture, and we focus a lot on sharing information. And we, I think, truly do believe ourselves, think of ourselves as a team. I could do a great job with my business, but, or let me rephrase this. Edward could do a great job with his business. But if I suck at running my business, I've taken all the positive contribution that Edward made to the Chenmark share price, and I've just, eroded it all. So Edward has an incentive to make sure that I'm doing my job and I'm getting the support I need and all that sort of stuff, and helping me through the inevitable hard times that every single company has, no matter what. So I think for a certain type of people, that system resonates with them. And so for us, it's just about making sure people know about the different paths that are out there. Ultimately, the more talented people we have out there in the world who want to become the leaders of small businesses, the better that is, I think, for everybody. And so just trying to make sure that people understand the different paths and options for them is what it's all about for us.
Thank you for that. We have a hand raised. Yvette, go ahead.
Yeah, thank you, Trish and Edward, for taking time here. And it's kind of nice. You can see kind of that you guys seem to work well together in the little jokes and little things that y'all are doing. I had a question of why you chose to go with the HoldCo model. So that's a model that I'm leaning towards, and I have particular reasons, mostly based on like the quality, the life that I want and how I want my life to live. If you think of like Alex Wilkinson and how Tiny is run, so it's kind of like that. But I'm curious why you specifically chose that versus planning to sell, whether it's in 2, 3, 5, 7, or 10 years, whatever the timeline is. Why a HoldCo?
Well, I guess there's two aspects of it. One is the diversification. So one is probably a deep sense of insecurity on wanting to bet on one business, and at least coming from previous roles where it was all about portfolio construction, and you never know what might happen in one business. So sort of making sure you don't have all your eggs in one basket and can diversify away risk is something that I think just speaks to our personalities, and we're very happy sort of trading away potential upside of one business to basically sort of protect the downside by having lots of different businesses in different industries and different geographies, and making sure we kind of live to fight another day. That translates also into a long-term hold. For whatever reason, when we started it, it just felt natural to us to say, we want to be long-term holders. Where that comes from, I have no idea. It just was something that we talked about, and it just felt right to us. But that also speaks to the need for us, at least for diversification starting out, because the more diversified we are, the more likely it is we can make it through various market environments, and be around to, tell the tale in, 20 plus years or whatever long-term means. So honestly, I think it's just a reflection of our personalities and our value systems.
Yeah, thank you. I appreciate the transparency.
There was another hand raised. It looks like it got lowered, so maybe it got answered. If not, please put your hand back up. We have a question for you, Trish, on the start of your HoldCo. And I probably will follow it up, add to it. So the first question is, how was the fundraising process when you started Chenmark? Did you raise capital or use your own capital?
Yes, so we used our own capital. We tried to raise capital, and as it turns out, nobody wants to give money to a husband, wife, brother-in-law founding team with no practical experience in operations or deal making. So we had to go to the people who will always support you, which was close friends and family. But it was primarily our own capital to get started, which ended up being a blessing in the long run.
So you bought the first company, used that to pay for the second company, and that was your plan going in, as I understand it. Do you have any views on how you should space out acquisitions into the portfolio or anything like that?
I mean, we have always just been opportunistic. So we've always felt like if there's an interesting opportunity, we should try to figure out how to make it happen. We ended up growing quickly at the beginning because we had more inbound than we expected to have, particularly, in the landscape space. But that ended up, after a couple of years, we had to sort of take a pause and be like, what are we doing here? That's around when Edward joined us, when we were like, we've got these businesses, but what does it mean to be a Chenmark business? And what are our incentive plans? And what is our recruiting strategy? And what do we really want to be? And so we ended up taking almost a year or two, and we didn't really do any deals because we just had to focus on organizing ourselves and what we were trying to do, and sort of what's the role of us versus the portfolio company and all these sorts of things. I think there's something that you don't really sketch out on a piece of paper. I think you can only really figure it out by doing it. And so the answer to how quickly should you go? I mean, some people might be more thoughtful and more prepared than we were when we started. I mean, we bought our first business. I remember it was all exciting. We closed the deal. And then the next day we were like, what do we do? Do we go to the office? Do we not? Do we what? We had no idea, what do you do then? And so I think the pace of acquisitions is probably quite personal and also dependent on the opportunity set that is available to you.
We have a hand raised. Anesh, go ahead.
Thank you so much, Trish. I have a question for you. So I have acquired companies in the past, and I'm leaning towards the HoldCo model to acquire online companies. So when you acquire companies, do you focus on a particular industry, or do you just see what you get a good deal?
See what is interesting. Our criteria are, what do we think we can, does it have a history of steady cash flows? And do we think we can own the business for the long term? And if it meets those two criteria, then we'll look at a lot of different things.
Okay. So owning a business is definitely tough. And when you're owning 10 businesses, it's going to be so much more tougher. So how do you manage that? Like, say if you're getting a landscape company, a moving company, and now a painting company in Texas. So how do you manage like having 10 different companies and going through the complexity of each company?
Well, you got talented people like Edward to come and work with you. I think we've realized that it's all about, if you have the right person in charge of running the business, it is actually flows pretty well. If you don't have the right person, it can really be quite a painful process. And it can really feel like you're grinding your gears. And so that's why we end up spending a lot of time on recruiting and training and making sure we've got the right people from a cultural fit. Honestly, like, I think James Palmer and I we all like business, and we all like learning about different businesses just fundamentally. So honestly, like, having 10 different businesses to learn about the drivers of those businesses, that's fun. Like, we enjoy that. Like, that is not a problem. And I think we've also learned, there are some basic business fundamentals you kind of have to like learn and understand for every business, no matter what it is in our world. But then beyond that, it's all about making sure we understand that, like, I am not running Edward's business, like Edward is running his business, and making sure he's empowered to do that is what is like the secret sauce for us.
Gotcha. Just a follow-up question. So do you look for synergies between these companies at all?
No.
Not at all.
No. No.
Okay, gotcha. Is there a reason why not? Or if there was a synergy, say if you acquired a marketing company, you'd be able to provide marketing services to your, all the companies that you have. So is that something that has crossed your mind, and then have you chose not to do it? If so, is there any reason for that?
Yeah, I mean, we've certainly thought about it. It's just that I think we're really, again, maybe it goes back to like deeply insecure or conservative or whatever, is that in deal underwriting, we don't like to assume synergies. We don't really like to assume we do much good of anything with our businesses. We just kind of assume we can keep it going straight. And so like, as a result, like, it would be very hard for us to do a deal based on assuming it could provide services to us. Maybe at some point in the future, as we get a bit more confident in our operating model, it could be something we'd look at. But honestly, we've just kind of looked at every deal as a standalone deal, assume nothing other than sort of some modest growth. And that's pretty much the only way we'll kind of do a deal. So it just hasn't really been in our DNA. Doesn't mean it doesn't exist and wouldn't work for other people. It just hasn't really been the way we think about it.
Gotcha. And also, in terms of having the operating CEO, how do you have their skin in the game when it comes to operating different companies? Like, do you give them an equity share, or do they invest some money into the business? How does that process work?
Yeah, they get a split of the free cash flow of the business.
Okay. Super. So no equity as such, but it's just they get a share of the cash flow.
They get a share of the cash flow, and they have the ability to invest that amount into equity in our shares.
Super. Got it. Thanks so much for answering my questions.
Of course.
So I have a follow-up to something that you said, Trish, because sometimes searchers have questions about, like, particularly on the traditional search model, like I could become the CEO of a company, and then maybe it's not a good fit, or maybe something happens, and then am I going to be fired, and what does that look like? And it sounds like you've had experiences where the CEO might not, good company, good CEO, might not be a good fit for each other. How have you managed that in the past?
Yeah, we have. I mean, honestly, it was kind of before the GVP program. And in the past, honestly, it wasn't a good fit because the person was a bad, every issue we've had has been a person hasn't been a good cultural fit because we haven't done the work up front to make sure that the person is truly sort of on Team Chenmark. We have this framework of missionaries versus mercenaries. And I think we hired some mercenaries that were really just in it about, making a quick buck for themselves instead of really trying to run the business for long-term, durability and cash flow generation. And so that's where it's been an issue for us. Now I think something that happens in search that people usually when you're searching, you don't think much about is that usually if you're in this space, you're a talented person and you're ambitious. And Edward may do this job, say be CEO of Mainly Grass, and maybe he'll step into it and he'll love it and he'll become part of the community, and his family, will be part of the community, and he has no desire to leave, and he wants to do that job for the next 20 plus years. Great, that is awesome. And if somebody wants to do that in our model, like they're 100% support to do that. But then sometimes, someone might say, you know what, I've done this job, and for the past, 5 years, but now I'm interested in doing something else because I feel like I've kind of taken it to where I can or whatever. And so we've had some people who have done that. So we actually had a CEO of one of our businesses. This is the sort of the game of musical chairs that we have to think about, but we had somebody who was kind of looking for a bit of a change. He left to run a new acquisition. Palmer, who'd been running Mainly Grass, went to run that other company, and then Edward stepped up to be CEO of Mainly Grass. So we have a lot of sort of moving around. The only thing there is you just have to be mindful that leadership changes are, disruptive to the business and people working in the business. So, you can't have people moving around, oh, I'm bored after 9 months, I need a new job sort of thing. Like that's not what this is, but we really hope when a person joins us in the GVP program that we will be able to offer opportunities for them throughout their career, and that they will be able to satisfy whatever sort of ambitions that they have.
One thing I want to add there that I do think is a particularly important point for our setup is that when you're kind of selecting a business to become the CEO of, it's really important that you're excited about that team, you're excited about the community that it serves, you're excited about the service delivery model or what it is. And I think when you're kind of doing a traditional search setup, you can kind of get locked into a setup that might not actually be a great fit for you. What I think has been awesome here is that there's a range of options. It's not like you're forced to become the CEO of this business or that business. You do get the opportunity to find a business that's a great fit for you, which I think is a really big deal and a really unique and rare opportunity.
Thank you. Thank you both. Next question. We have about 5 more questions, so I know we're going to go over. Feel free to say that you tap out. I hope you won't, though, until we get through these questions. So the next question starts with a thank you for your speaking on ETA panels over the years, Trish. A heartfelt thank you for that person. And they're wondering about how you're financing your acquisitions now. Are you using a combination of the free cash flow and debt? Are you able to use the SBA still, or how does that work?
Yeah, so we've actually never used the SBA. It just is the way it worked out. But we use a combination of free cash flows, the equity. Most of our deals have some form of seller financing, and then bank debt. That's pretty much how the world goes around for us.
Next question. You talked about the CEOs being able to buy into equity each year. Do you issue new shares of Chenmark shares? Do you issue new shares of Chenmark each year is the question.
Yeah, we would issue new shares every year. The people who get the brunt of the dilution are James Palmer and I, but we're okay with that.
So next question refers back to the IESA webinar, which was earlier this week, and I'm hoping that if you did not attend, that they do make that available by video. One of the things that they talked about at the webinar was that first 2 years after an acquisition, making sure that you're reflecting the EBITDA might contract. Are you noticing any advantages of the Chenmark model, the team aspect of it, on that transition period?
I'd say the only advantage we have is that we are not surprised when it happens. The reality is most businesses, like, I mean, I'm sure Edward knows, like you take over a business and like the first thing everybody asks for is a raise. So like, you know, you have to deal with some sort of like wage inflation. You're going to probably invest in some sort of system they didn't have before. There might be some inefficiencies. You know, most of these businesses that we look at, like, it's not like they've got a lot of fluff, you know, they're tend to be run pretty lean. If anything, the owner was running it kind of too lean in an unsustainable way. So that's, you know, usually some cost creep is pretty expected in the first year or two.
Yeah. Somebody, one of the videos that I was watching or webinars was saying how Clay came in after they bought the company and said, I was told I'm supposed to ask for a raise. So I guess there's like something in the rumor mill that says like new owners, let's get a raise. I did not know that, but now that I know, I might try that too, right, in the future. So the next question is on your capital allocation. How do you make decisions at the head office level, and is it based on a specific hurdle rate?
So it's a little bit of a complicated question. So basically, every company gets charged essentially a capital charge on the equity invested in their business. At the moment, that's a 15% hurdle rate. So if Edward is making investments that have less than a 15% hurdle rate, he's not acting in his own best interests and would be better off returning that capital to us, where we can deploy it somewhere else. But if he has opportunities that, you know, surpass that hurdle rate, then often he's in his best interest to, you know, make that investment in the business. And so, you know, one question we get sometimes is, okay, well, you know, you're using business to cash flows to buy new businesses, so you're sort of starving your companies of cash. And we'd say that the first and highest uses of our capital is within the businesses that we have. And so if we could deploy all of our capital into those businesses, we would, but the reality is that the investment opportunity set in the businesses that we have tends to have quite high returns, but is limited. And so that is where capital goes first. And then after that is what we use for new acquisitions. And, you know, we underwrite all of our deals to have a 25% cash on cash return as our baseline assumption for a deal. And so anything below that, we will pass on.
Thank you. I know that there's a couple of searchers who are probably going to be adjusting their models as they're thinking about HoldCo strategies right now. The next question is about what comes first. Does the GVP, Edward, come first and then the business acquisition? So do you have both in mind, or do you kind of look at your pipeline and say, oh, we think that this deal might close, we need to get somebody who's got something kind of expertise?
Yeah, the GVP always comes first. So we find that if you're in a position where your deal is about to, or you have a deal even in mind, and there's some sort of timeline associated, and you don't have a person in mind to run that business, you're going to feel pressure. And I know that this has happened to me before, where you might get lucky and find the right person to run the business, but you could also pretty easily explain away a lot of red flags and justifications because you want to get the deal done. And so, you know, we feel pretty confident in our ability to find deals, but we feel that if we have GVPs ready to go, we can be much more aggressive about going out to find deals. Because in our experience, finding the right person to run the business is a lot harder than finding a deal.
So would you mind sharing like how many GVPs that you have that are kind of waiting in the wings to be a CEO?
Ooh, that is a good question that I should know the answer to. I'm going to go with 7, somewhere between 6 and 8.
Yeah.
I'm not going to name them all off right now, but yeah, that range.
Yeah. Right. And then for the folks who might be looking at Chenmark, about how many are you thinking you might bring on in the next year?
We're looking to hire about 5 to 8 this year.
Okay. So a question for you both. I'll start with Trish and then Edward. So Trish, I'm sure your day-to-day has changed from the first acquisition to now you've got 10. What does your day look like? What are you doing?
What do? I do a little bit of everything. I have a very random day. I still do, and it's changed a little bit because I was running one of our businesses, but I'm slowly transitioning it to another person. So still kind of involved in some of the day-to-day stuff with that business to make sure that that transition's going well and kind of staying on top of things. And then I still do a lot at headquarters in terms of I manage all of our like overhead budget and some HR stuff and all that sort of stuff. And I also write our Weekly Thoughts newsletter, which everyone on this list should sign up for because it's great. And then somehow I also haven't found anybody else to get the mail, so I still do that.
Totally understand. And if you haven't signed up for the Weekly Thoughts, I will ditto what Trish has said. I've been reading the Weekly Thoughts for years now and really enjoy them,
Awesome.
And I commend you on your persistence of being able to get them out every week. That's something. So Edward, you're new CEO, 10 weeks in. What is your day like?
I would say it varies pretty significantly day to day. Certainly, it's a lot more emails, it's a lot more calls. We're very much in these businesses, operating these businesses. I was at our one of our branch locations today, meeting with all our branch managers to talk about our onboarding process for the year, our purchase order process, and inventory management process for the year. So it varies a ton day to day. We're in our off season now, so we're planning for the season ahead. We're very much involved in the business on a very day-to-day basis. But I'd say certainly a big pickup on the emails and call volumes since transitioning.
So I'm going to ask one last question for each of you. What is one thing that you know now about running companies or entrepreneurship in general that you wish you had known when you first started? It could be any aspect, the emotional, the mental, the tactical, the strategic side, whatever it is. What is that one thing you wish you had known?
Well, I remember very clearly pretty soon after we bought our first business, having just a feeling of so much more appreciation for all of my old bosses because it looks so easy to be in the seat and like, at least for me, easy to criticize like the silly, decisions they're making. But then when you're in the seat and you realize that, oh, I really only saw like 2% of what was on this person's plate, and it's really hard to manage all those priorities and be thoughtful in meetings and make decisions that are hard ones that people are going to be upset about. It's hard. It's harder than it looks, and it's a very I don't know, with maybe overwhelming feeling at first for me. And that's something that I probably didn't appreciate going in.
I would say the biggest for me is there's certainly a temptation when you're in a business to hey, you don't want to lose that customer. So you're going to cut them a break, or you don't want to lose that employee and God forbid, go backwards from a sales perspective. So you're just going to kick the can and lower the bar. And while those things seem crazy scary initially, and you're just trying to patch the holes, it just never works out. In the end, it's just not going to work out for you. So, raise the price to what it needs to be for that customer. And if you lose them, you lose them. And, same on the employee side. Ultimately, that short-term pain is going to be to your advantage. And if you try to stem that short-term pain, you're just not going to make progress.
Thank you both. I'm going to give you a round of applause, and I hope that others will give you visual or emoji applause. Thank you for being on the hot seat for so long, and thank you for being here and what you're doing for the ETA community in general. Really appreciate it. I am going to stay on. I'm going to end the live stream and the recording. I will stay on if people have just general questions, want to chat, but you two are free to go because I know it is evening your time.
Awesome. Well, thank you so much for having us. Great to be here.
Thank you. Thank you guys so much.
Bye.
Bye. I'm and let me